So direct equity vis-a-vis mutual fund, which has been a debate which has been going on for decades, which I think can be put to rest very easily with two pieces of data. First, let me give you one piece of data which tells you the concentration risk which direct equity brings, the news risk which you also alluded to, which direct equity brings, the kind of lower research risk which it brings. So all these risks which direct equity brings to one's portfolio. How do you measure that? Now, let's look at last 1 year. We tried to see out of NSE 500 stocks, which are just the top 20% of India's stocks, there are 6 stocks which are more than 50% down in a 1 year period. There are 25 stocks which have fallen more than 40% in the last 1 year of holding. There are stocks, 57 stocks minus 30%. There are 25% ke zyada girne wale, 112 stocks. More than 10% fall, 179 stocks. So what point I'm making is a stock can also fall 50%, 40%, 30%, and not 1 or 2 out of the 500. We are speaking about 57 fallen more than 30%. Now let me read out mutual fund numbers for you. How many mutual funds in India in 6 different categories fallen more than 50%? 0. More than 40%? 0. More than 30%? 0. More than 25%? 0. More than 10%? 4, 5, 6. 6, 0 to 10% is about 30-40 of them. And there are a substantive portion positive. So the point I'm trying to make is a mutual fund, even in a year where there has been a catastrophic fall in this calendar year, in the full financial year, you don't see any mutual fund in 6 different categories more than a fall of 25%. Whereas I read out so many stocks more than 25% fall. So that helps you understand and comprehend the risk you take when you buy stocks. Let alone the news risk, this is the risk of a 1 year holding period I'm talking about.